Hey everybody, this is Jose Blasco here. We're about to get started. Before we start, I wanted to have a quick sound check. Please go ahead and confirm with a quick message that you hear my voice.
Everybody,
this is sound okay here, or good morning. Started. Before we start, I wanted to have a quick sound check.
Thank you
Please
so
go
much.
ahead and confirm with a quick message that you hear my voice.
Everybody,
This is sound okay here, or good morning. Started. Before we start, I wanted to have a quick sound check.
Okay, so everybody,
let's get started with our session. Today we are getting together for longer term, isn't it? This is sound okay.
Let's begin.
Good morning. Welcome to the session, everyone. My name is Jose Blasco. I will be your guide.
Okay, so everybody, let's get started with our session.
Today we are getting together for longer term, isn't it? Longer term, okay. Good morning. In other words, welcome to the session, everyone. My name is Jose Blasco. I will be your guide.
Okay, so everybody, let's get started with our session.
Today we are getting together for longer term, isn't it? Longer term, okay. Good morning. In other words, welcome to the session, everyone. My name is Jose Blasco. I will be your guide.
Okay, so everybody, let's get started with our session.
Today we are getting together for longer term, isn't it? Longer term, okay. Good morning. In other words, welcome to the session, everyone. My name is Jose Blasco. I will be your guide.
Okay, so everybody, let's get started with our session.
Today we are getting together for longer term, isn't it? Longer term, okay. Good morning. In other words, welcome to the session, everyone. My name is Jose Blasco. I will be your guide.
Okay, so everybody, let's get started with our session.
Today we are getting together for longer term, isn't it? Longer term, okay. Good morning. In other words, welcome to the session, everyone. My name is Jose Blasco. I will be your guide.
Okay, so everybody.
I see why. That's it. Should be fixed now. Yes. Yes, I see why, guys. Sorry for that. It was a little mistake on my side with the sound settings, okay? But anyway, just out of a final confirmation, give me a confirmation now that is good. Yeah, it's good now. Yes. Yeah, silly mistake on my side, guys. Anyway, so let's get started. We have many things to do. We have 1 hour of time to go ahead and find a collection of trades of different sorts. 30 minutes from now the market will open. Ideally we'll be ready with some of the trades so we can start executing quickly. Okay, and as always, okay, if you look at my TradeStation here, we're using scanning technology, right? That is looking at different types of trades where the 2 on the top are directional and the 3 on the bottom are not. And within not being directional, we have the neutral trades, neutral long, neutral short. And then we have the purely non-directional trades, okay, which we call non-directional, okay? So 5 types of trades to be identified and 5 types of opportunities to be explored in the marketplace. And we will begin by looking quickly at what's going on in the broad markets, because remember, stocks are a fragile asset, isn't it? So we'll begin by looking at what's going on. Well, as you can see, the market closed in a green UFO yesterday, and from there price is bouncing up, which is obviously not a surprise. We have overnight trading, pre-market trading is up by 0.38%, so not a surprise that there is some reaction from this UFO, and we'll see what happens next. Because there is no red UFO, so potentially that S&P can move very, very intensively to the upside, okay? That's why I was quite excited some time ago planning the trades that we did with Starbucks, also with American Express, because stocks making all-time high right before the S&P does. Well, if you enter at that time, you may have a nice push, and then when the S&P starts breaking out, then you have a second nice push, and that could be the recipe for very nice profits, okay? So we'll explore and see if we have opportunities of that sort as well to be executed. When it comes to the VIX, which measures the prices of the options, meaning that our options more in the cheaper window, or our options more in the expensive window. So you can see that options are likely about to become expensive, reacting to the green UFO. This makes it more interesting to me to begin our day and begin our session looking at directional opportunities, because for us to execute directional opportunities, long or short, what we're gonna do is to purchase options. That's why we got the D for debit. Debit means we buy, you pay, it's a debit. And if options are about or likely to increase their value, reacting to this green UFO, so you know what, it may be sensible to go ahead and begin planning trades where we are going to be purchasing options. Having said that, and I did make a couple of comments about this in the past. We will have to discuss at some point as well portfolio management, because the fact that I'm gonna plan a long trade or a short trade doesn't necessarily mean that you have to execute it, because maybe your portfolio already got too many longs or too many shorts, and it would not be good for you to add. Okay, but since we haven't got there, I'm just gonna look at this from a kind of like perspective where in a perfect world all trades would be good to be taken. Okay, so let's go ahead and let's begin by analyzing JCI. And also, this is the first time since we are doing get-together sessions for longer term purposes. This is the very first time that we are doing a session after the sharpening session that we did last Sunday, where we were talking about the long term. We had never had a sharpening session discussing long term, but now we did, right? And one of the additions, okay, one of the improvements that we have added, more to come next Sunday, by the way, but one of the additions was to have another time frame where in this time frame, in this case it's going to be daily, we're going to be looking at the same things that we do when we trade futures or Forex. We're going to be looking at trending conditions by looking at the EMA, looking at the DMI to understand what is the market environment. And once we understand the market environment, so you know if you should be on the long side or the short side, then we will look at the main chart, okay, by using the edge time frames, which should be 55, okay? 55 when you use the daily time frame, okay? 144 when you use the weekly time frame, isn't it? So 55 when you use the daily time frame, right? 144 if you use the weekly time frame, okay? And 377 if you use the monthly time frame, okay? Those would be the time frames to be utilized. Would be perfect edge time frames. If your platform does not allow for 55, 144, 377, so alternatively you could be utilizing 60 to 140 daily. Okay, but as you know, the ones on the left are gonna be more powerful. Okay, they are more aligned with the concept of edge timeframes. Okay, good. So let's begin. Okay, we got JCI has been scanned and has reported. Our scan has reported that this stock potentially is gonna be a good candidate for us to go long. Okay, so we're gonna look at the 55-minute time frame, as I just said, as an edge time frame, and notice how you know that because of the colors here in the middle, right? You can see the blue, you can see the magenta, and what does that mean? That means that we are charting pre and post market information, and with the pre and post market information, to be honest, I'm not too happy in the case of JCI because we got 48%. It's not really giving us an edge. So if we were to look at the regular session hours, then now we get 54, and now this is gonna make me much happier. Okay, again, we know stocks are a fragile asset by definition. Okay, we know stocks are a fragile asset by definition, and therefore, we need to be careful and sensitive when it comes to planning trades on those particular stocks, because they depend on what the broad market is doing, they depend on what the sector is doing, etc., etc. So we'll want to be as precise as possible with the timing. And I love the fact that in the case of JCI, even though I just said we want to be as precise as possible, well, at the same time, knowing that stocks are fragile, it's very nice to have a collection of UFOs on top of each other the way we have, because that UFO may not work well because maybe the S&P is not hitting a UFO, but if that doesn't work well, the next one is likely to work, and hopefully at the same time the S&P will hit a UFO, and if that was not the case, then we have another one to defend ourselves. And in other words, we have multiple opportunities to have this trade work for us, and that's a nice setup because, again, you probably remember that we said that when executing those directional trades with options, we buy options, and therefore the most you can lose is what you pay for the option. So you could afford the luxury of entering the trade with no stops, knowing that your risk is contained by how much you paid for the option itself, and having multiple UFOs gives you a better probability that if that one fails, the other one will work, or the other one will work. And because the because what you pay for the option limits the risk of the trade. Again, it's absolutely fine, absolutely right to stay in the trade with no stops. You can see, for example, here on the left, you can see JCI, where let's say, for example, at this moment in time, and give me a second, guys, because it seems that for whatever reason my drawing, okay, now it's working, okay, got it. So for a moment, my drawing capabilities on my computer were gone, so that's gonna be helpful. They are back with me. So notice how that particular day we got price come to the average, okay, we had a strong trend, okay, and maybe you have got into a trade. If you have got into a trade with a stop, when you see JCI go against you, maybe you've been stopped out and you're out of the trade and you lost, okay. But again, notice how the trend was strong all the time. Okay, and maybe the stock had to go deeper all the way to this point just because maybe the S&P was not finding support. So now let's say a few days later the S&P found support and is now pushing the stock back up. So because you would have never used a stop in this particular initial day when you took the trade for the first time, because again, when you purchase options, the most you can lose is what you pay for the option. So you could enjoy such a luxury, which is to stay in the trade with no stop, knowing that your risk is limited. So now you are back in business the moment that a particular stock started moving your way. Okay. Now, of course, the more we time the trade, the better price we'll get. So you don't want to enter, for example, here. Okay, that would be a little bit, kind of in the middle of nowhere, where if you were to enter closer to the average, okay, well, the closer to an average price you are, the less expensive you buy. Is that making sense? And therefore, we want to time the trade with the use of the average, with the use of the UFOs, knowing that we need to give ourselves a little bit of wiggle room for fluctuations because we are dealing with stocks, and stocks are a fragile asset. Okay, so again, kind of rephrasing certain things that I've said before, but it's important that you have the right mindset, the right thinking when dealing with stocks, especially if you also trade futures or Forex, because there is a different story. Okay, Forex or futures are markets that got life on their own. Okay, they are big enough to get out of the trade when you're wrong. Where we stop with stocks, you may be wrong 1, 2, 3 days, but then it goes back. Okay, so because again, they depend on the broad markets and so on and the sectors. Okay, anyway, so what do we have? Well, JCI is a particular stock that is providing this possibility for us to ride on a large move. Now, because the trend is strong, because remember, the close, and by the way, because stocks is not a 24-hour market, normally to assess the trend, you will look at the prior close and the average, correct? But because the stock market closes and will reopen later, okay, the prior close really is the current candle, because that current candle already finished yesterday. When the new candle begins, it's going to start in this portion of the chart, isn't it? That's going to be where the new candle goes. So the candle prior to the last, really, in the case of stocks, is actually the last candle because it closed yesterday, 4 p.m. Eastern time. So what happened yesterday? We had a close above the average and we have the DMI pointing green. So we have a strong uptrend. So what is the second step tell us to do, right? First step, look at the market environment and decide what is the right side. Step 2, set the targets. And for you to set the target, we're going to use UFOs. Okay, we're going to use UFOs, but not on the daily time frame. You would use it on the daily time frame if the trend was weak. But since the market environment is strong, we're going to move to the weekly time frame and see if there is a red UFO there for us to plan on the trade. And yes, there is. Okay, so here is where the red UFO is, which is located at 44.92. Okay, so 44.92, that is the location for the target. Okay, final target. So I'm making a note on my side because obviously we're gonna use this value, 44.92. We're gonna use that value to calculate the TTT, isn't it? We're gonna use this value to calculate the TTT. So back to daily time frame. Disable UFOs, we don't need them there anymore. We only need them in the middle part. And now what do we want? Well, we would like to see JCI to fall until it gets to this UFO, right? And from there, we would purchase options, in this case calls, and expect the move to happen until JCI reaches 44.92. 92, okay, which is a very, very nice move. It's like a $6 move on a $39 stock. That's a powerful move, okay? Now, what's the problem that we have? The problem that we have is that that stock pre-market is already trading 1% higher. So that stock is gonna open at $40 per share, okay? $40 per share, and may actually break this red UFO, which it should because it's an uptrend, and in an uptrend, sell on field orders tends to be canceled. Maybe for the stock to break the UFO, we may have a little bit of a reaction, and ultimately it goes, okay? But basically, another approach for this trade, I'm going to give you two approaches, the patient approach and the less patient approach, right? So the patient approach would be that you wait until that stock reaches to 38, and then you will buy the options, which are going to be calls, and ride the move until it gets to 44.92, as I said before. That's going to be the patient approach. The less patient approach would be to, wait for that stock to break the red UFO. Once the red UFO has been broken, you had confirmation that the on-field orders have been taken out. And the only way to take out the on-field orders is by adding buy orders. So sell orders became buy orders, and therefore somewhere in that region, and we don't know yet, we'll see it later because the AutoUFOs app will plot it for us in like 55 minutes of time. But basically, maybe here, okay, maybe somewhere in the middle, you are likely to have some green UFO, right? So another way on how to plan for this entry would be a less patient entry. Okay, I'm not saying improvising, I'm just saying it would be less patient, but it's all pre-planned, okay? So it would be a less patient entry where you would be buying as that red UFO breaks, okay? So that would be another way to plan on this trade. No matter your timing, meaning you want to be patient and wait until it drops to 38.84, or you don't want to wait and you just want to see the red UFO traded through, no matter your timing for the trade, when is your entry time, the options that you're gonna buy are gonna be the same. What we're gonna buy is gonna be a bull call spread. Okay, we're gonna buy a bull call spread. I'm trying to shrink my chart here so everything looks more in proportion. We're gonna build a bull call spread, which is gonna be done by selling a call beyond the target point. Okay. So that's going to be a bull call spread, and we're going to be buying a call somewhere around here, okay? Maybe the 40, maybe the 41, and then sell the 45 or something like that. So we're gonna plan for this trade in a minute, okay? But again, this trade, which is going to be made of two calls, the one you buy and the one you sell, that trade will be entered either when that stock drops to 38.84 and then you buy the bull call spread, or if you are less patient, wait for this particular stock to break the red UFO, and that's when you enter. I said less patient because in both cases you have to wait. You have to wait until it comes to the green, or you have to wait until it breaks the red. But breaking the red probably will take less time because it's an uptrend. But in both cases, both could be. Now notice how interesting how now that stock is probably back to 39.3. Maybe it was just a bad tick in the pre-market session, or maybe actually there was a big trade that took place and then and that's it. So that could be the case as well. Okay, so let me take a look at your questions before I continue planning the trade. Yes, exactly, dear. That, like in AXP, again, having a red UFO being taken out means on-field orders have been removed, and if the on-field orders have been removed, the money didn't evaporate, isn't it? So sell orders become buy orders, basically. Okay. Altong, are you thinking if price come to 38.84, the EMA will move to that level? Well, in the case of stocks, I'm gonna be a little more flexible. I'm going to be a little less demanding with the EMA. That's a very good point, Al, because when we do futures or Forex, we want to make sure that the EMA is lining up very well, with a green UFO. But at the same time, I told you at the beginning of the session and many other times that stocks are fragile, and you can see how with stocks, the kind of like the fluctuation around the average is a little more intense compared to what you see in Forex or futures. And it's just because of the nature of what stocks are. It's not like it's wrong or anything like that. It's just like the way it is. Okay, it's a normal thing. So that's how it is. So therefore, because that's how it is, I'm gonna be okay to be less precise. Okay. Now, in any case, even though I'm gonna be okay being less precise, I am certainly envisioning that if that stock drops to 38.84, that average, which is currently 39, that will probably open higher to maybe 39.5. Okay, that average will drop back down maybe to 39.05. So if it's 39.05, it's a little above the green UFO, but I'll still take it because again, with stocks, I'm okay not being so precise because remember, I'm not gonna use stops, isn't it? I'm gonna use risk management by knowing that the most I can lose is what I pay for the options, but I will not stop the options trade out, and therefore I am okay being less precise. Okay, so very good point. In a perfect world, everything would be lining up, okay? But at the same time, we also need to learn to be flexible with stocks because think about it. When I run the scan, how many stock results I got? I got only one. So, if I was to be that picky, which again, it would probably make the trade even a tiny or better, but then I would execute many less trades, okay? So with stocks, we need to learn to be a little more flexible and give ourselves a little bit of wiggle room. Wiggle room in this case means that the average may not be lining up perfectly with the UFOs. Wiggle room means that we are relying on multiple UFOs. We are not relying on one UFO only. So, it's all good, okay? So that's a little bit of a slightly different mindset, and that's a very good point, a very good question, okay? How are you, Bojan? Good to see you. I was the implied volatility is not very low, and if the price will drop, the IV will go even more. Well, first of all, maybe yes, maybe not, Mario, because it's not always the case that a stock is dropping and the volatility goes down. Sometimes the volatility goes up when the stocks are rallying. So that stock, has created a very big move compared to the prior candles. Maybe one of the reasons why the volatility is higher is because the prior day was a pretty large range candle, and that could be the reason why the volatility was a little bit expanded. Second, if the stock comes back to us, that may actually cool down market participants because maybe the fact that the market is falling is just because there is limited amount of buying, so people are quite calm. So it's not always the case that when the markets go down, volatility goes up. It happens more often than not, so I 100% get your point, but it's not always the case. So we don't want to be strongly biased in that sense, right? So the fact is that my scanning rules are giving me permission to trade JCI. And then on top of that, we are being very smart with the options methodology to be used, which is a spread, right? And as you know perfectly, Mario, by doing a spread, you are mitigating the amount of gamma you will use on the trade. Also, the expiration date that we're going to use is going to be 40, 50, 60 days. So the amount of, I think I said gamma, sorry guys, I meant vega. The amount of vega you're going to get is not going to be that much. And because it's a spread, it's going to be even less. So you know what? Let's say we were to be wrong on the implied volatility aspect of the options trade. Well, it's not going to kill us. Okay. And if the stock does move from 40 to 45, this trade will be profitable no matter the IV. Okay, so of course we want to be sensitive to the IV, but we are already doing it when we are scanning. And IV is one of the things where we don't want to be that perfectionist unless you were doing Vega plays, which that would be a different type of trading where you are basically trading volatility itself. That would be a different story. You can scalp it and you can do certain things with volatility. Well, then yes, you have to be very sensitive. But for a pure directional trade, what's going to pay you the most is the direction. Okay, and that's what we are focusing on the most, and mitigating the Vega risk with the scanning parameters together with the type of option strategy that we have used. Okay, if you were to do a bull call spread, right, and you were to do this spread with 120 days out, well, you still have a lot of Vega risk, but we are not going to use 120 days out. Okay, we are not going to do that. So so let's calculate the TTT. Let's go for it. Let's calculate the TTT. So I'm grabbing a calculator here. TTT, for the ones of you new to the session, TTT means time to target. Okay, so we said our target is 44.92. Okay, let's say we enter the trade when it gets to 38.84. right? So we are talking about a $6 move. That's what we're shooting for. What is the ATR for that stock? So I'm gonna insert analysis technique. I'm gonna add average true range. Here we go. And the average true range, as you can see below, is 58.79. So if I take my $6.08, I divide it by 58.79, that tells me it's gonna take 10 weeks. 10 weeks times 7, that's gonna be 72 days, okay? And therefore I have a TTT, and therefore I need a time to target or an expiration date that provides at least 72 days, okay? So when looking at not only the TTT, but when looking at the earnings report, which is the other rule that we have on how to decide on the expiration date. So JCI. So let me move it to the side. So we can see we got an expiration date of July 30, and that is not a good news. Okay, that is not a good news in the sense that this is much shorter time. I'm loading the Option Station Pro to see the options available. The options will be reset to 0 now because we are 3 minutes away from the open, but it's okay for me to check the dates and the expiration dates available. That's going to be good enough. I mean, in a perfect world, I would want it to be 72 days or more, but what's happening here is that I am being given, okay, one sec, I am just loading JCI. I got the option chain on my other computer screen, so I'm just moving it now. Here we come. So here is the option chain, and you can see that we have July 19. We said the earnings report is July 30, so we can use July 26. Okay, that's the most we can use, and that is 43 days to expiration. Now, this is not ideal because we have a TTT of 72. Okay, 72 is our TTT. So what's happening here? Well, what's happening here is that we have a market opportunity which is amazing in the sense that the target seems to be quite far. And realistically, we could get there because there is nothing to stop price from getting there unless the broad markets turn around and the whole market falls and therefore stocks follow. Because remember, stocks are fragile. Okay, but if the market goes up, that stock has potential to potentially move faster than the market and reach 44.92, which is the target. But the problem is that given the pace at which the stock has been moving at, which again in recent times is been a little bit sideways, so it may not be fully representative, but if the stock keeps moving at the same pace, well, it seems that we don't have time enough to get there. Is that making sense? We will have to exit the trade prior to this date. Okay, because when we get to this date, earnings may be reported, and if the earnings are bad, the stock may gap down against us 10%, and therefore all the profits you made, let's say for example, you get into the trade when that stock breaks, okay, and you get into the trade here, and now you're in, and now the stock is moving, and you are very happy, and now that's the earnings day, and next day the stock gaps down here. Well, congratulations, you still got a little bit of a profit from here to here. Okay, from here to here, you got a little bit of a profit. Okay, congratulations. But you lost all of that. Okay, why? Because you stayed in the trade and you got a gap on earnings. Okay, so the rule, as you probably remember from other sessions, is that we get out prior to earning. Okay, the market just opened, by the way. So we get out prior to earning. That's the rule. Okay, and unfortunately, or fortunately, depending on how you want to look at it, okay, our target is far enough where we may not be able to get there, okay? So then, the rules that you need to keep in mind is that we're gonna enter the trade, we are still gonna target for 44.92 because there is no red UFO until we get to that price. So let me tell you, we may get there in 40 days, but at the same time, we want to be aware of that date, so you will need to make a note for yourself, okay? Where we are aware that the earnings date is July 30, 2019. Am I saying this right? Yes, July 30, 2019. By the way, you will need to review it because those dates may fluctuate. It may be 5 days before, 5 days after. Sometimes it will change when the date is approaching. So you will want to watch it and make sure you are out of the trade at the latest the day before that date. Okay, so keep that in mind. In any case, we will target, okay, that particular final point, which is gonna be 45. Okay, so 45 is right here. Okay, 45 is right here. This option really is paying very, very little. It's paying basically nothing. Okay, you got 22 is the ask, 0 is the bid. So there is not much there, and unfortunately, I'm really not happy of seeing what I see, because as you can see, and I know what happened to the stock. I mean, this stock was not the most liquid stock in the world, but definitely at this moment in time, the spread available is huge, from 59 to 126 or 104 to 179. It's a huge spread, even at the money strike, which is the current strike. So I'm very unhappy to see this, and therefore I am tempted to look at the monthly expiration date, which probably will be better, even though it's gonna invalidate our rule even more. Okay, still liquidity is not there. Okay, and we got a few thousand contracts here traded. So let's do this. Let's do this because at this level of liquidity, I would not be happy executing this trade. Spreads are too wide, but it may just be just because the market just opened and that stock is not the most liquid in the world. Again, based on my memory, based on what I remember of that stock, I would say liquidity was a little better. So what we'll do is we're gonna go ahead and plan other trades, and then we'll come back to JCI to see if the liquidity improved and take the trade just a little later in the day, because right now I'm not comfortable, okay, with this level of liquidity. In any case, okay, even though this trade is not valid for us to execute, I think that it was a good refresher of certain things. Okay, so let's go ahead and begin planning on short opportunities. Okay, so I'm going to start with the ones that I know are more liquid, like Best Buy. So let's begin with BBY. Then we'll look at Delta Airlines as well. So when looking at that stock, the prior close, let me take a look at the prior close. That was 64.45, where the average was 64.54. So we had a close below the average. Okay, we had a close below the average. And this particular stock is currently trading inside of a red UFO. Now, this red UFO is slightly above the average. Again, I said earlier that we're going to be flexible, isn't it? Because in stocks, with futures or Forex, you will never do this, right? You will want the confluence with the average and the UFO. But in this case, even though the current price is slightly above, we also have the red below, and we are willing to give ourselves a little bit of room and tolerance to be able to absorb these kind of things, because this is common in the stock market because stocks are fragile. Okay, so here's the setup that we have in front of us. 54% is what the 55-minute time frame gives me. With regular session, pre and post market would give me instead of 54.43. So certainly not a good idea to use pre and post market. We'll use regular session for BBY, and we are actually in a price level where it's time to take the trade. So what I'm going to do is look at the weekly time frame to be able to set my target. I'm going to activate the UFOs to see where is the next green UFO. The next green UFO is right here, and right here it would be 54.04. Okay, so that's BBY. So now that we know what the target would be, 54.04, that's a pretty powerful move. It's a 10-point down. Okay, so let's see let me refresh the option chain. Let's see what do we have in the option chain, as well as we need to calculate our TTT and also look at the earnings. Okay, so TTT would be the difference between the current price, 65.15, which is the entry price because we are inside the UFO, so it's time to get in, and 54.04, which is the final target. That would be $11.11. And we're going to take that figure and we're going to divide it. We're going to divide that figure times the ATR, where, as you can see below, the ATR is 174.79. So 1111 divided 1, 74, 70, 74, 79, 75, 79, sorry, 75, 79. Okay, that's gonna be 6 weeks. 6 weeks times 7, that's gonna be 44, 44 days to achieve that target. So our TTT is, okay, so I'm not sure what's happening in my trade station here. Okay, let me see if I got the drawing working, and that was the cause. Okay, just want to disable, here we go, our restore range. And basically what we're saying is that we need 44 days to get to this final target, right? That's our TTT. And we also need to check on the earnings, which is gonna be for BBY, it's going to be August 27. So that's very good. Okay, that's very good because it's beyond 44 days. So let's see what the option chain is giving us. The option chain on BBY, you can see BBY on the upper left, right? So the option chain on BBY, if we look at that August something, it's going to be August 16. That August 16 expiration date is giving us 64 days to expiration, which is better than the 44 that we need. That's ideal. That's exactly how you want it to be, isn't it? And therefore, it's going to be time for us to plan on a trade. So let's do it. We're going to use August 16. Let me move this up just to be a little visual. So we are shooting for a target located at 5404. That was the figure that we concluded earlier. And what we're going to do is that we're going to buy a put. That's going to be called a bear put spread. We're going to do that using August 16, 2019 expiration date, knowing that the earnings are on August 27, 2019. And then a little beyond the target, we're going to be selling a put. Okay, so we're going to buy a put and then sell a put. That's how we will produce our bear put spread. Okay, let's begin first by looking at the put to be sold. We would want 54 or below. Well, 55 or 50 is what we are given. So then we would need to use 50, right? So I would sell the 50 put. Okay, that's gonna be the one. And then when it comes to the one I will be purchasing, okay, so what I'm gonna do now is I'm gonna kind of reverse generate. Okay, so I'm gonna right click to analyze and buy a vertical. Okay, analyze and buy a vertical. Now what happens here is that I got the put I buy, which by default came as 62.5, and the one I sell, which I define, I want it to be the 50. Okay, and what we said is that we want a delta of around 30 plus. Okay, so we have a delta of 28 negative. We want it to be negative 30 plus. So I'm going to reverse generate, and I'm going to leave the 50 fix, okay? And what I'm going to do is just move the 62.5 to 65, and now I get 39, okay? And therefore, it seems that this would be the trade to be taken, unless I could find a combination that makes me a little closer to 30, which I'm going to try going back to 62.5, and then grab that 50 and drop it to 47.5, and that is giving me 30. Okay, so that is going to be a more accurate representation of the deltas I want based on prior lessons that we have covered, around 30 plus. So that's it, we got it. So we're going to do 62.5, 47.5. This would be the trade to be executed. Okay, so 62.5 put and 47 0.5 put. If you were to execute this trade, and by the way, it's time to do it now because we are inside the red UFO, isn't it? So this is a trade that would cost you 185 if you get the midpoint. So per contract, you would pay $185, and therefore the most you can lose is $185. Okay, and now you would be in this trade. Okay, and since we are in the right place, okay, and hopefully you guys are following, I'm gonna look at your questions in a minute. But since we're in the right place to take the trade, I'm just gonna execute it. And I'm guessing you guys are going to be doing the same with paper money, real money, bigger size than me or the same size than me, because I'm using one contract at a time. So you decide on your size, and you decide if you want to use real capital or not. Of course, that's you. But if you want to mimic me, of course, I welcome you. And here is the execution of the trade. And the moment I execute it, I will go ahead and give you instructions to manage the trade and what to do if what happens, right? So we'll talk about the what if scenarios. So since I am executing this trade in a simulated environment, with TradeStation, I'm going to have to go ahead and use a market order because this is how TradeStation deals with options traded in a simulated environment. But if you are trading this with real capital, I would suggest that you begin with 185, okay? And because the natural is 204, maybe you want to be just a little more generous and you go for 190 or something like that. But I would just stay there until you get filled at a very good price, okay? In my case, I'm just going to go ahead and go for market, place an order, click yes, and the moment I do that, as you can see below, the order has been filled. So I am now short, that 47.5 put, and the prior indication I got flashing here was I was also long the 62.5 put. In other words, in my account now, if I was to look at the manage and I was to look at BBY, you can see in this account, I now have 2 units where I am long the 62.5 and short the 47.5, which I could go ahead and drag it on top of each other. And basically this is my vertical spread, 62.5, 47.5. And if you want to see the details, you can always expand and you would see the same information. Okay. So now if you do nothing, you now know the most you can lose is 185 or 190, or in my case 204 because I got natural price, market price. Please don't do that. Make sure you use a limit order, not market, okay? But the most you can lose is what you pay for it, okay? In my case, it's 204. But now, the other thing that we need to discuss is what to do depending on what happens, because now you are in the trade, and of course, our expectation now is that this red UFO will bring the prices back down, okay, until we get to here, okay? And this, again, it's a stock. So stocks are fragile, and therefore we will depend, okay, we will depend on multiple things that may happen. We will depend on the market trend, on the S&P, it will depend on multiple things, okay? So we may get there, we may not get there. So you would want to, make sure that you have some sort of a technique on how to follow and maximize your profits in case you never got to your final target. If you were to do this in a portfolio with multiple positions running at the same time, you would need to understand how many longs, how many shorts should you run at the same time, etc., etc. Okay, and we'll talk about all of these. Okay, but I do want to give you some basic, at least some basic instructions on how to manage this. Okay, but let me look at your questions first. So, Royce, what's bar on your setup? What's bar on your setup? Oh, okay. Bars back and calibration. Yeah, I'm using 1,500 bars, and calibration is 0.618. Yes. Oh, thank you so much, Mario. I'm just realizing that that you got that. Yeah, Bojan. Quick unrelated side note: took the crude oil trade T192. Love it, Bojan. Way to go. Way to do it. Supply and demand trader, you are filled on the Interactive Brokers live account at 185. Very good indication, guys. Okay, so if supply and demand trader got filled at 185, you guys should not be shooting for 190, as I said. You should be shooting for 185 or maybe 186 or maybe 184. Let's try to get the best price as possible, okay? Knowing that now you have a reference, okay? This is fantastic teamwork. This is why it's so good that you guys comment on the comments box, because now this also gives you a reference. Because when you look at the trade here, okay, I mean you could guess, okay, what when you do this, analyze vertical, right? Or you place the order 62.5, 47.5. You could certainly look at the midpoint, now it's it seems that it went up a little bit. So it seems, am I using the right strike? Yes. So it's 163. So now it's a little bit of a better price. Okay. But sorry, 173. I was looking in the wrong place. 173 is a little bit of a better price, but your reference is 163, 183, and you never know if you're gonna get 173. Where if you guys are executing those trades, and a minute ago we got different prices and it was showing 185, and supply and demand trader you got 185, okay? That's a great reference for the group, and I thank you very much for you sharing that, okay? So good job, by the way. So here we go. So we are in the trade, okay? Now, what to do? Okay, what to do? Well, two things may happen. Well, one thing that may happen is that this thing starts going higher. The other thing that may happen is that that particular stock may start moving in our direction. Okay? So let's begin with what if it starts moving higher? Well, if it starts moving higher, remember, don't panic. You know the most you can lose is 185. Does that make sense? And you should be happy with this risk. And if you're not happy with the risk, you should not have taken the trade. So just let it be. Just let it be. Okay? Because that stock has a higher UFO, the S&P has other UFOs, or potentially new UFOs will form, and if this trade will end up working, at some point it will come back towards you and end up giving a profit for you. Like it happened, for example, with the Starbucks trade, where for a week or two it was moving against us, and finally it ended up providing a nice profit. Okay? So, same idea. Just wait, okay? Probably you are running this trade in parallel with other trades too. So if you got a few longs and you have a few shorts, and this one is failing and the other ones are working, so you are fine, you're gonna be delighted. Does that make sense? But in any case, if you were to look at this trade independently and it goes against you, again, just don't panic, just be patient. Know the most you can lose is 185. Let the market do its thing. If it doesn't come back, you will lose 185. If it does come back, you know, you will start being in a profit. What's working for you is the fact that you are in a trending condition. Based on our rules, the prior close was below the average, the DMI is showing strong, meaning red, and therefore, even though now we are above the average and now temporarily it may not look too good, the fact is that that stock is in a downtrend, and like it may have happened before, we had instances of being above the average for a few days, and finally you had the push you wanted, okay? So don't panic and let the stock do whatever it's gonna do, because it's gonna do it anyway, no matter if we panic or we don't. Is that making sense? So that is what to do if it goes against us. Now, what if it goes our way? Well, if it goes our way, in a perfect world, it will reach our target, which is 54.04. That's our target, 54.04, okay? Right there. So we would reach our targets in a timely manner. That would be amazing. But what if it's not the case? So what you will want to do is, in one hand, you know, keep observing those red UFOs, okay? Keep observing those red UFOs, okay? And as long as you are back to be below the average, okay? Because if you have red UFOs above the average, I mean, let's say, for example, this market went up and then gives you a UFO, right? But that UFO is above the average, okay? Then there is nothing to be done, because you're in an uptrend, so you are in the don't panic mode, and, you know, let's see if it comes back or it doesn't. Is that making sense? But if you do have red UFOs that begin forming, okay, below the average, okay, red UFOs that begin forming below the average, okay? So those UFOs would be somewhere in this region, okay? Somewhere in here. So what you would want to do then, okay, is that now you could now utilize stops to set stops above those UFOs to protect those profits that you started making, okay? Now again, the issue of doing that is that stocks are fragile, okay? Stocks are fragile, and therefore the problem of doing that is that you may have the stock move against you all the way, stop you out, and then react to the average, which is a little higher, and then go back down, and you are out of the trade for a small profit, which is, I mean, it's still a profit, but it's too small compared to the profit you could have collected if you have given yourself a little bit more room for breathing. Okay, guys? So we need to learn a few extra techniques, okay? You heard me talk about damage control at times. and we will learn a few techniques on how to produce a very interesting effect on taking advantage of gamma while you are in a trade. Okay, and for the ones of you that are options experts already, so what we'll be doing is that we'll be producing trades where when you get to a certain level, where you started with a delta, and this is going to be a little technical if you are not an options expert, okay, but bear with me because we'll have lessons where I will explain this properly. But if you started with a delta of minus 30, okay, and that stock went down, so now when the stock is, somewhere in this region, now what's going to happen with your delta is that your delta now is minus 40 or minus 45 or whatever. So what's happening here? Well, you have a positive gamma position. Okay, your position is positive gamma. That's why your negative 30 became a negative 40. It has increased because gamma is positive, increased in a negative fashion because it's puts. Okay, and something that you could do, and this also depending on your account size, we'll explore different possibilities. Let's begin with large account sizes. So let's say you have an account size greater than 125K. So then you would apply for portfolio margin with your brokers. And then what you could do when you get there is you could buy shares. Okay, buy shares against your bear put spread. Okay, that would reduce the reduce the delta, locking in some profit, but leave you in the trade with still positive gamma. So if the market was to move against you, okay, up against you, you would lose less. If the market was to move your way, you will start making more again. Okay, and so it's kind of scaling out, but it's a dynamic way to scale out thanks to the positive gamma. Okay, now this would imply buying shares, which are very expensive. Okay, so you need a lot of leverage, and the only way to have a lot of leverage would be to use portfolio margin, which is only allowed normally for accounts greater than 125K. If your account is less than that, so then we look at other possibilities. Okay, also depending on where you are in the world. If you're outside of the States, maybe we'll add CFDs in your account. If you are in the States and CFDs are not allowed, so then what we'll do is that we'll use deep in the money options, which are going to be way cheaper than what the stock is, okay? And they will produce a similar effect than using stock shares, okay? And we'll be dealing with this to do a very intelligent approach for when the trade works in your favor, okay? When the trade doesn't work in your favor, again, we'll be in not panic mode, and later in time as well, we'll have to conduct sessions to talk about damage control mode, where we will also butterfly and do certain conversions of the option strategy to mitigate the problem, okay? But anyway, you can see there is room for improvement here, big time. In any case, we're in a trade with BBY, okay? And apart from supply and demand trader, we also have Altong filled at 187 on TradeStation. So good job, my friends, okay? And if you are not trading options, or you like options better for non-directional instead of directional, then my recommendation is that you should execute this trade in a demo account, paper trading, just out of growing your level of experience and practicing options trading, so you get to see how it is, okay, if you were to be a person with less experience, okay? Because it's gonna be eye-opener. No matter if the trade works or it doesn't, you'll get to see what happens in both cases, and from a skill building point of view, it's going to be very useful. Okay, good. So very good. So now there are more opportunities which I will leave to you to analyze. Okay, now because we looked at one long, one short. Before I give up on JCI, I will want to one last time go ahead and look at the option chain to see if the spreads got better, because if the spreads got better, we'll plan on a trade. If the spreads didn't get better, so then that means that, at least out of my memories, which maybe I'm wrong because there is many stocks in the market, but what I kind of remember of JCI is that the liquidity was a little better than what I thought before. So hopefully we'll have a little bit better spreads. And if we don't, we're not going to force it. We don't have the power to change the market, but we do have the discipline to adapt to what the market gives us. Okay, so that's exactly what we're gonna do. Be disciplined and adaptable. Okay, so JCI, we talked about using July 26 expiration, and yeah, spreads got a little better here. Spreads got a little better with July 19, 91.79. Yeah, well, that's way better than before, isn't it? That's way better than before. Like way better. Earlier it was absolutely terrible. So let's see if we can have a trade that makes sense on JCI. Let me scroll down. So I guess, oh, here's my typing from before. So we said we would buy a call, we would sell a call. The target above was 44.92. Okay, that was the target. 44.92, which remember we said it's very unlikely you will get there. Okay, very unlikely you will get there, but still it's okay to give ourselves the opportunity because the chart is supporting the trade. So if that was to be the case, we're gonna start with the 45s. So go ahead and picking. I'm gonna use July 26. Okay, the earnings was July 30. So analyze by a vertical where we are selling the 45, okay, and the one that we are buying, let me delete and delete. So remember we want a delta of 56, okay, so I'm gonna go for, we want a delta of 30, sorry, so 40, 41, yeah, so 41 doesn't do it, and 40 give us 41, which is a little more, but it's okay. Okay, so we can do this trade. If you do this trade at mid price, you would pay 83. Really, 83 is at current price. Remember, okay, that we had two ways on how to enter the trade: the patient way and the less patient way. So the patient way was you would wait for price to come to 38.84. Remember, that was the patient way. So we're gonna buy the 40 and sell the 45. Okay, so you would want that, right? So therefore 38.84. Let me simulate it. 38.84. Right? So this tells you that if you were to do this, you would expect the value of this trade to be around $50. Okay, so that's the patient approach to this trade. If you're gonna be less patient, okay, and you're still gonna be patient because you'll wait for this to go through, right? When it gets above 40.04, okay, so let's call it 40.05. So when it gets to 40.05, 40.05, so what would the option price be? It would be 96. Okay, so of course the price is gonna be more. Okay, the price is going to be more. Well, it's obvious because you know markets went up and therefore calls gain value. And on top of that, we are talking about a full point. Okay, $1 something, you know, $1.25 more or less. So you know we are talking about a nice move or a nice distance between the UFOs. So obviously the patient approach gives you half the risk, but also you may never get filled because it may break out and never came back. Is that making sense? But again, the perfect entry would be down here, given the fact that we are lining up with the average and all those things, okay? So that would be the very perfect approach for this particular trade, okay? So yeah, so you got your timings and you got your data, okay? So how would you place the order, okay? So let's say you want to be the patient guy, okay? So you would come in here, click trade, okay, and now you would activation rule, change this to market, activation rule, and you will now add the price for JCI, add, and you will want this price to be less or equal than 38.84. Okay, so this would activate the order. Okay, you activate the order based on the price. So if the price of the stock is below this, then the order becomes active, and you would be purchasing the 40 call and selling the 45, creating a bull call spread. And therefore, I'm just gonna place the order. Confirmation is yes. 1, 2, 3. Yes, that's it. I got the order in the system. Okay. Good. So let me take a look at your questions. Actually, no questions, so I guess everybody's following. We just reached the top of the hour, by the way, so it's kind of time to conclude the session. It seems that today we didn't have time to do any non-directional trade. But again, based on what we saw on the VIX earlier, today is probably a day where the options prices will go up a little bit. Probably a better idea to enter those directional trades, okay? So good job with following the session. Yes, Devan, go ahead, please type your question and I'll be delighted to give you an answer. Good job, guys, following the session. Please, if you have any final questions, such as Devan, anyone else, please, this would be your time to type it. So we can go ahead and give you an answer before we close the room and conclude the session today. By the way, anyone by any chance attended the special session that we did yesterday with the do's and don'ts in trading? Just curious to know if you were able to join me there. In future, is derivative of SPY? Not sure I fully understand your question, Evan. You are saying if the SPY is made of S&P futures, or? Yeah, Brian, you were there. ES is derivative of SPY, so how come we have to roll over gap but not in SPY? Okay, so let me explain this. Okay, let me explain this. So SPY is the symbol for an ETF. Okay, I'm going to use a daily time frame on the main chart just because my charts load faster like that. So SPY is the ticker symbol for an ETF. And that ticker symbol, that ETF, is made up 500 stocks, which happens to be the 500 greatest stocks in America, which also happens to be the same 500 stocks that make up for the S&P 500 index. Okay? So what I would like to do to answer your question properly is first to talk about what's an index, because the index is $INX. That is the index. If I type $INX, okay, $INX, I get the S&P 500 index. Okay, that's the index. So what is an index? An index is a mathematical calculation that averages the performance of 500 stocks. In other words, you add 500 stocks and then you divide whatever the number is by 500 and you get the average performance of those 500 stocks. That's an index. It's a mathematical calculation. It's math, and you can plot it, and therefore you can get a chart. But I want to make sure you understand and everybody understands that indexes cannot be traded. You cannot trade the S&P index, because that chart, I mean, what happens if I try to place an order? So, you know, symbol, $INX, right? So if I try to place an order, let me tell you what's going to happen. It's going to give me an error message. It's going to be like, what you're trying to buy cannot be purchased. Why? Because an index is not tradable. It's an index. Now, it would be very convenient if an index was tradable. Okay, that's a thought that took place in the market, you know, decades and decades ago. Someone said, you know what, it would be very nice that the index is tradable. Because for now, when they created the index, they use it as a reference. Okay, you wanted to know what the market did or what the market was doing to be able to trade the S&P. Okay, it would be very nice to be able to trade the S&P. Okay, again, the index is not tradable. So what happened? Well, people started thinking about it. Okay, and humankind, we can be very creative, isn't it? So they came up with ways to trade the index via other products, okay, that derive their value from the index. Okay, other products that derive their value from the index that is not tradable. Okay, and what are those other products? Well, options. So you can trade options on the S&P 500 index. Okay, let me show you. So I can get my option chain here. I need to reset it. One sec. I'm going to reload it and you will see. So those would be options that derive their value on the index. Now, remember, an option, a call, gives you the right to buy, but we said you cannot buy the index. So how do we deal with this? How did the markets created those products? Well, because they are what we call cash settled options, which means that when it's time to, give me a second. When it's time to, I was getting a pop-up window here on my other monitor when it comes to Option Station Pro. So hopefully it's loading. Okay, so I think something happened here. Let me reset TradeStation very quickly. Sorry for that, guys. So let me reset TradeStation and then I will show it to you in an orderly fashion, and then we'll conclude the session. Okay, guys. So again, trying to do this as quick as possible. So back, logging in. Something happened to the option chain, gave me an error message. Good, so loading, almost there. Good, so again, the thought was, let's create an index so that way we can understand better what's going on in the market as an average. And that was very convenient for market analysis. Second thought was, hey, you know what? It would be very convenient to be able to trade an index. But an index by definition is not tradable because it's a mathematical calculation. So they had to come up with an original way on how to create products that are tradable that represent the index. And the first one was options. Okay, so let's take a look. I'm just gonna open Option Station Pro. I'm sorry to keep you waiting, guys. It's a very good question, Devon, because many people don't think about it the way you did. And it's always good to understand when you trade, what do you have in your hands, isn't it? So what kind of thing you have in your account, right? What's the nature of it? Okay, so it's a very interesting thought. So here, as you can see, I'm gonna load on the upper left the symbol $INX. Okay, and when I do that, okay, notice what $INX. Okay, yeah. For me to get the option chain, I need to use spx.x. Okay, sorry for that. Yeah. So it's actually the same symbol in TradeStation. $INX or $spx.x. Okay, great. So now it's giving me a timeout error. $INX or spx.x. That would be options on the S&P. But remember, when you buy options or you trade options on the S&P, you have the right to buy, you have the right to sell, but you cannot buy or sell an index because it's not tradable. So therefore, this is what we call cash settled options, which means that on the expiration date, what happens is a mathematical calculation. If you had the right to buy and the S&P went up, you would have had a profit. So instead of buying, you have a profit cash settled in your account. If you had the right to buy and the S&P went down, and then you would have a loss. So then you cannot buy because it's an index. So what will happen is that the loss you would get is cash settled in your account. So now you can speculate and profit up and down from the index without owning the index. That's when options on the S&P were created. That was one way. Another way to trade the index was futures. Futures is also a derivative. Okay, so they took, the same index, the INX or the SPX.X is the same thing, and they created futures contracts. Okay, they create contracts. Now, what is a future contract doing? Okay, and why is it called futures? It's called futures because if you were to purchase that contract, you get physical delivery in a future date. Again, you cannot get physical delivery of the index because it's not tradable. Okay, you cannot get physical delivery of the index because it's not tradable, but it could be cash settled, just like the options. Is that making sense? But still, the difference between options and futures, and that's why futures is called futures, is because the price of the futures contracts is determined by the future date, and therefore the expectation for that future price of the index on that future date. Correct? So, therefore, in futures markets, if you have been trading futures for a while, you know there is something called a backwardation or contango, which means that are market participants expecting the S&P index to be higher in 3 months' time, or are they expecting it to be lower in 3 months' time? And depending on that, the value of the futures contract for the S&P is higher than the index or lower than the index. And also, if you look at different expiration dates in the futures contracts, you have different prices, which have to do with not only the time, but also the expectation for the future price of the index on that future cash settlement date. Okay? Anyway, now you get a market that is tradable. Okay? And then they came up with also ETFs. Okay, which are exchange traded funds, which basically is, the company that created this is purchasing 500 stocks for you, and when you buy the ETF SPY, which is the most common that represent the S&P 500, there are more. So when you buy the ETF SPY, basically you are being invested in 500 stocks in one shot, because there is a company behind the scenes that is kind of like routing, if you wish, it's not like that, but kind of. So they're kind of routing your orders to those 500 stocks, where you get filled in all of them, little portions of it in all of them. So mimicking what the index is, even though what you got is equities. Okay? So long story short, Devan, because that was a long kind of like explanation that I just gave you to be able to answer your question properly. So why is it that you have rollover gaps on the futures, but you don't have on the SPY? Well, because the SPY is an ETF and is made of stocks, and stocks don't have future dates. Stocks have current dates, where with futures, every contract that, as you know, expire every 3 months, got different prices depending on contango or backwardation, and therefore there is a different sharpening session. Will be part 2 of long-term trading and investing. We will get much more into the how to do it, where last weekend we talked about many things that are very important for you to be aware of, but it was more into the what to do instead of the how to do it, where this weekend it will be more into the how to do it. So if you haven't watched last weekend's session, make sure you watch it, make sure you don't miss it, okay? Very good, everyone. Super pleasure to spend this hour with you guys, and keep up the good work. Delighted to see your emails coming in, your comments, and see that you guys are doing very well as a group of traders. And every week I can see you guys improving in your results and so on. And if you are not sending emails to us, make sure you do, okay? If you have questions, shoot us an email. If you just want to tell us that everything is going very well, that will make us very happy. If you were to be struggling in any way, make sure you let us know too, because that way we can help you better. If you don't speak up, then we are limited to help you because we don't know you are struggling. Okay, so make sure that if there is anything we can do to help you, you let us know. You guys take care. Huge pleasure again. See you soon. See you on the weekend. Bye bye, everyone.